I think we can start now. A very good afternoon, everyone. Welcome to this webinar, which is themed on income tax implications on entrepreneurs. Thank you for spending some time with us today, and I'm very sure that this webinar will keep you engaged throughout. Let me introduce myself first. I am Nayan Surve, a chartered accountant qualified with an All India rank in CA final examination. Just give me a second. Yeah. Let me resume my introduction. I'm a member of the Institute of Chartered Accountants of India since 2019. I started off my career with the India's leading corporate in finance sector, and I worked upon into areas of finance, majorly taxation, finance, and internal audit as well. So, having worked in a corporate for 4 years, recently last year I started my own venture chartered accountant firm. The work areas that currently keep me engaged are tax consultancy, tax compliance, and also I have started exploring the bit of the sector of audit and assurance as well. So that was about me. Now I'll introduce today's eminent speaker, CA Chaiti Londhe. Chaiti is a chartered accountant and practicing as a partner in Gokhale and Sathi Chartered Accountants. The firm having its head office in Mumbai and branches in Pune and Jaipur. She has been in the profession for 10 years now and engaged in providing income tax advisory, consultancy, litigation services to various corporate and non-corporate associates. Her clientele also includes charitable trusts, cooperative banks, as well as sports association in India. She has also contributed articles on income tax publications of various professional bodies as well as web forums. She has co-authored publication published by Bombay Chartered Accountant Society. She has been a part of tax audit quality review group of ICAI in the past. Welcome, Chaiti, to the session. Chaiti, you may please unmute yourself.
I'm sorry, yes. Thank you, Nayan. Thank you for the introduction. I'm very glad to be a part of this program.
All right. So before starting the actual session, I would like to give you a brief background about this platform, WEP. WEP stands for Women Entrepreneurship Platform. So it is an initiative by Government of India through NITI Aayog. It's a unique public-private partnership to build robust entrepreneurial ecosystem for women. This platform aims to provide support through pillars such as access to market, access to finance, business development services, networking, financial literacy, compliance, due diligence, and many more. So the overall vision is to provide opportunities to empower women to start and sustain their business, and not just start and sustain, but to scale up their business to heights. So this platform has arranged today's session along with its knowledge partner ICAI, the Institute of Chartered Accountants of India. ICAI is a statutory body set up by an act of a parliament under Chartered Accountants Act 1949. The institute has recently completed 75th year of having the remarkable journey in the sector of finance. The institute functions under the administrative supervision of Ministry of Corporate Government of India. Chartered accountants play a pivotal role in economic development of the country. Their expertise in finance, taxation, auditing helps ensuring efficient functioning of not just private but public sector as well. Okay, so I'm hoping that this is going to be a really enriching session for our audience. So the topic today is about income tax and income tax implications on entrepreneurs, especially small businesses and startups. So as you all are aware that tax season is going on, and you must have heard the birds out of it, right? So throughout this session, we are gonna cover many things, right, from the basics of income tax to some detailed concepts like compliance requirement under the Act, or benefits available under the Act, or special exemptions or deductions available under this Act. So some of you could have started up their business recently and facing the teething difficulties while growing them up. Like it could be anything regarding what is the tax structure applicable to your business, or what are the requirements with respect to maintenance of books of accounts, or what is audit, and is audit applicable to your business, or things like that. Or on the other hand, some of you might have been in the business for quite longer time by now, and now you want to scale up your business to great heights. So the questions that may be in your mind are like change in the organization structure, or more precisely, if I want to pinpoint the scenario, then if you want to convert your small business into a private limited company, what would be the tax implications in those cases? If these kind of or similar questions are in your mind, then this webinar will definitely shed some light on the subject matter. So keeping those things in the background, let me ask the first question to our speaker, Cherry. Cherry, to kickstart the session, can you please elaborate the basic concepts of income tax? Like what is considered as income in the first place? Or who is liable to pay tax on that? What are the tax rates and the related topics around that?
Yes, definitely, Nan. So even I get such questions from my friends or relatives who have, been carrying on some business or who are getting into new businesses, that we don't know anything about tax, and when some notice comes up, there's a lot of anxiety that it causes us, and they have a lot of questions relating to compliance and many other. So let me begin with some basic concepts of the Income Tax Act. On a lighter note, when I was just going through some posts on social media, I came across one interesting post which said there are only two things which are certain in life, which is death and taxes. So I found that to be very
Definitely,
amusing.
definitely. I'll also agree with that.
Yes. Yes, coming back to the topic, I know that it caused a lot of anxiety to the new business owners. So it is always, though, of course, while I may give some basic information about how the entire tax system works and what are the nuances of certain issues, it is not an alternative to the professional advice. However, it is always better to have at least a conceptual clarity or to know certain basics while you are getting into it. Unfortunately, our education system, though taxes are inevitable for everyone, we generally don't have tax as a subject unless you opt for commerce. So, a lot of people don't have any background whatsoever when it comes to taxes. So, let me start with very basics. uh, so let us first understand what are direct taxes and what are indirect taxes. Though today's topic is income tax, there are a lot of circumstances when I receive some notices from friends or relatives who say that okay, we have got some notice from the income tax, but they are using income tax as a term in a very generic sense. Often I found that the notice is from GST or from customs. So let us first just spend a couple of minutes on understanding that. So income tax is a direct levy on income of a person, which is a central levy, which means that which is levied by central government. As opposed to that, indirect taxes are something which are levied on provision of services or sale of goods. So the basic difference is unless you are earning income, you don't have to pay taxes. The tax is on income earned by a person, whereas indirect taxes are on products or services. So take an example that suppose I'm a student, I'm not earning anything, I'm not required to pay income tax. However, even though I may not be earning, I go to the market and buy some commodity. That commodity has in its price inbuilt some GST portion. So even though you may not realize it, you are paying some part of indirect taxes when you buy any kind of services or products. The only difference is while the levy of direct tax is on that person who is earning income, the levy of indirect tax is on a person who is providing that services. So that GST is collected by your service provider or the person who is selling those products. The collection obligation is on that person, but ultimately the end consumer who is purchasing those products or services is the one who actually bears that levy of tax. So that is the basic difference between income tax and other indirect taxes. So, having said that, now let us take some basic concepts which are very necessary for understanding the income tax provisions. The first, of course, when I'm talking about income tax, the first concept is income. Okay, so what constitutes income? Let me take an example. So suppose if I receive something for providing services, I receive my professional fees of say rupees 100. Can you say that it is my income? Or maybe I sell some capital asset belonging to me. I receive I sell my house. I receive say 50 lakhs of rupees. Can you say that 50 lakhs is my income? The answer is no in both the cases, because what income means has been specifically defined in the act. Okay, so there are five heads of income which have been defined under the act. First is of course your salary income. The second is income from house property, that is the rental income that you earn from letting out of your house property. The third is income from your business or profession. The fourth is income from capital gains. And the fifth is other income. So, whatever revenue receipts have not been covered in these four heads will fall under the residuary head of other income. So, in the example that I just gave, uh, in these under these five heads of income, there are certain provisions given as to how to compute that income. The example I gave is me receiving some professional fees. Now if you go to the head of income, which is profits and gains of business and profession, there are certain rules as to how to arrive at your net income. So there may be certain allowances that I'm entitled to out of the gross receipt of say 100. I may have incurred some expenditure for earning that income, which will be allowable as deduction. And only the net income will be taxable under the head income from business and profession. So, what is meant by income? You have to refer to the specific provisions of that chapter. So that is how the income is computed. Now, there may be certain receipts which are in capital nature. For example, I receive something for giving up my source of revenue. I'm running a business. I get some money to discontinue that business, maybe for non-compete or something like that. So that receipt will be in a nature of capital receipt. Okay, that is not your source of income. You do not earn that regularly. So in that case, unless there is a specific provision under the act to tax that receipt as an income, generally it will not be taxed. So in case of revenue receipts, you can general rule of thumb is that it will be taxable under either of the five heads that I mentioned. If it is a capital receipt, though, it has to be specifically mentioned that it is taxable as income. Otherwise, it will not be taxable. So that is what we mean by income when it comes to the levy of income tax. Now let us go to who is liable to pay tax on their income. The tax is on a person who is earning the income. So what do you mean by person then? So the person has also been defined under the act, and there are certain categories of persons. First category is an individual. Second is an HUF. Third is a partnership firm or LLP. Both have been categorized under the same head as firm. Fourth is company. Fifth is association of person or body of individuals. That is, so we refer to it as AOP or BOI. And the last one is artificial jurisdictional person. Okay, we will go one by one and see what each of them means. Individual, as we
Sure.
understand,
That's fine.
yes. Individual, as we all understand, means a natural person, you or me. Nayan is an individual, I'm an individual. So, if I'm running some business under my own name without resorting to any legal structure, suppose I have a small business, I may have a trade name, but that business does not have any legal constitution. So that will be treated as that business will be treated and income will be taxed in my individual hands. So the constitution is individual. When there is an HUF, of course, HUFs are governed by the laws, Hindu laws of succession and other family laws. So HUF has been defined under those laws. HUF can be taxed as a separate person under the Income Tax Act. Even though I am a part of the HUF, my HUF has a separate identity which is separate from me. And if that HUF is earning income, it will be taxed under its own hands and not in my hands. Then the third is firm. Now the firm, as I mentioned, can be of two types. One is a partnership firm. Other one is an LLP, which is a limited liability partnership. Limit LLPs were brought in by an act which came in, I think, 2008, if I'm not wrong. So the basic difference between the two structures is that under a normal partnership act, your liability is not limited, whereas under an LLP, the liability of the partners remains limited. Now, what do I mean by that is, suppose I am running a partnership firm, me and Nayan are partners in one firm, and it's a normal partnership. Normal partnership. So we incur some debts during the course of our trade or business. Now we are liable to pay them off. If for some reason that our business does not do well, it means that the debts incurred by the partnership firm will have to be borne by us personally out of our personal properties. However, limited liability partnership, the basic difference between other partnership and LLPs is that the liability remains limited. LLP is a separate legal person from its partners. So there is a distinction in the eyes of the law between the partners of the LLP and the LLP itself. So LLP is considered as a separate legal person. The income will be taxed in hands of the LLP separately, and the liability of the partners is limited in that case. Limited to what extent? To the extent that I have my capital invested in LLP. So suppose my capital balance is X and my debts are X minus something. So if there is a requirement that my business income is not enough to meet my debts, the debts will be recovered to the extent possible from my capital, and the balance I will be entitled to receive. If my capital balance is, however, not sufficient to meet the debts incurred by the LLP, then I will not personally have to reimburse those debtors out of my own personal property. That is the basic difference between partnership and LLPs. However, for the income tax purpose, both these firms and LLPs are considered at par and are categorized under the head firms. So all the rates applicable, etc., will be common for both these entities. Now let us go to a company. Now we all know that companies are governed by Companies Act 2013. Uh, the constitution is more or less similar to that of LLPs in the sense that company is also a separate legal person and the liability remains limited. However, for LLPs, there are restriction on how many number of members can join in an LLP. For a company, it is not there. So, if you are looking to have more number of people engaged in your business, a company will be more suitable rather than LLP. Having said that, of course, since the stakeholders are more in case of a company, the compliance regulations will be also stringent in case of a company rather than LLP. Then comes AOP or BOI. So now take an example of maybe a cooperative society or cooperative housing society. So it does not fall under any of these categories, right? Uh, because it
Correct.
is formed with a number of members, so it is not an individual, it is not HUF, it cannot be said to be a firm, it is not registered as a firm, it is not a company. What it is merely an association of number of individual persons. So AOP means exactly that, association of persons. So these categories will be, or maybe take an example of a trust. These categories will be coming under the head AOP or BOI. And the last is artificial juridical person. So any take an example of university or some board which is constituted under some specific act of the parliament, which does not fall under any of the other heads that I just mentioned, will come under this category. Now, what is the relevance of this categorization? So the relevance is certain provisions are applicable with respect to the category of person that you fall under. For example, just take an example of tax rates. Basic example. For an individual, there is a slab rate system which is applicable. That is a progressive rate of tax. However, for the firm, it will be flat 30%. So there will be many other provisions. For example, for our purpose, let us take an example of startup. So startup has mandatorily need to be either a company or an LLP. So individual cannot be registered as a startup, or partnership firm cannot be registered as a startup. So there are so all these provisions depend on the constitution or the type of person that you fall under within the meaning of Income Tax Act. So that is what I mean by person under Income Tax Act. Now let us go to, so we have seen what is income, we have seen what is meant by person. Now the next question comes, okay, I have this income, when it will be taxable? So there is a concept of assessment year in the IT Act. Assessment year means, so there is a financial year which is from 1st April to 31st March of next year. This is your financial year. Assessment year is the year immediately preceding that. So, for example, if my financial year is 1st April 23 to 31st March 24, the assessment year corresponding to this financial year will be 1st April 24 to 31st March 25. So, the immediately next year will be your assessment year. Now, generally speaking, whatever income is earned by an individual or a person in a financial year is taxable in the assessment year corresponding to that year. That is the general rule of the thumb. However, there can be certain examples where the taxability is postponed. For example, say that I have some personal capital asset. Now I'm starting a business and I convert that capital asset into a stock in trade. Now there is a specific generally this transaction under the head capital gains will be treated as a transfer, and it would have been liable to tax in that year itself. But there is a specific provision to say that even though the transfer gets triggered in this year, you will be liable to pay tax only when you sell that asset, or when you sell that stock in trade. So, or another example could be in case of redevelopment of properties. If you enter into a joint development agreement with any builder, so that format and conditions of when this qualifies as a JDA have been prescribed. But once you qualify for that, the even though the taxable trigger happens in year one, the tax liability arises in a future year when actually that project is completed. So there could be some situations where the taxability is postponed to other year, but normally whatever income is earned in one specific year is taxable in the assessment year corresponding to that year. Okay, so now we have seen what is meant by income person assessment year. Now, so at what rate the income is taxable? So, in some cases under the Income Tax Act, there are some specific rates which have been given, whereas the other types of income is taxable under the rates in force. Rates in force is something that is prescribed by every Finance Act, which is enacted every year. The other rates which are fixed or prescribed or special rates, we may call, those are prescribed under the Income Tax Act itself. Take an example of capital gain, the simplest one. Long-term capital gain taxable at 10%, and short-term capital gain taxable at 20%. That is a special rate that is prescribed under the Income Tax Act. One more example could be if it is a sports association or a sport person under 194E, the tax rate is fixed, prescribed under the Income Tax Act to be 20%. In all other cases where no special rate of tax has been prescribed, the income is taxable at the rates in force, which, as I mentioned, are enacted every year by way of Finance Act. So now let us have a brief look at the tax rates as well. For individuals, as I mentioned, the rates applicable are given in form of slab rates. So for the up to 250, there will be 2,50,000 income, there will be no tax. 2,50,000 to 5 lakh, it is 5%. Up to 10 lakh, it is 20%. And above 10 lakh, it will be 30%. Now, what is the logic behind enacting these slab rates for individuals? The answer is actually very simple. The person who is having or who is in a category of lower income slab will obviously spend a lot of or a large portion of his income on basic necessities, right? So whereas a person who is having a higher income will be having a large portion of his income at his disposal for investing or other activities. So it will be unfair to, prescribe just one tax rate for a person who is earning 3 lakh rupees and a person who is having 3 crore of rupees. So that is why there have been slab rates in case of individuals. So this is called progressive taxation. As you earn higher income, you will pay tax at higher rate. When we come to companies, uh, the fixed slab rate is 30%. But if your company is a smaller, having a turnover of below 400 crores, then it gets reduced to 25%. So for a smaller companies, 25% is the tax that you will pay plus surcharge and education cess at applicable rates. There is one provision 115 BAA which allows certain companies to claim 22% tax rate provided that they let go of certain deductions. So even in case of individuals, you must know that there is an alternative tax regime or new tax regime, which provided that. So basically, the object of this was to simplify the tax procedures. Okay, for individuals, there have been so many deductions that were available under ATC. So your insurance premiums, certain equity-linked investments, those were all eligible for deduction from your income. So that limit was 150 for ATC and 50,000 for certain other deductions. So you used to get that deduction from your taxable income. Now the government thought that okay, we need to simplify this procedure, so they came up with new tax regime. They said that okay, you will not get all those deductions. You will simplify your return. What you earn, you pay tax on that. But for that, we will have some reduced rate of taxation. So that was the new tax regime. Similarly, for companies, uh, there has been a new tax regime to say that if you let go of certain deductions, for example, for other companies, there are certain deductions available, for example, additional depreciation. So, on a new plant and machinery, you get accelerated rate of depreciation at the rate of 20%. If you are willing to let that go only from the perspective of simplification of your tax return, the government said that okay, instead of 25% you pay 22%. So you need to opt for that scheme. So once you opt for that, for companies it will apply unless you revoke it. So 22% tax rate is available subject to certain conditions. Now, there was also some more relaxation in case of manufacturing or companies engaged in production of articles or things. So that was introduced in 2019. So if the company is set up after October 2019 and it is engaged in manufacturing or production of articles or things, there is a certain negative list, the products which are not eligible for this. But barring those exceptions, everything is eligible under the head manufacturer. So if the company is engaged in manufacturing and the company starts production before 31st March 2024, then in that case you can claim a rate of 15%. So there is a lot of difference between other companies and manufacturing companies, but there are certain
Yeah,
conditions
almost
that.
10% of the gap is
Oh,
there as
absolutely,
an
yes.
added advantage.
Yes, yes. And if you say that my turnover is above 400 crores, then it's almost half. So 30% and 15%.
Right, right.
So if you are a new company set up after 2019 and you have already commenced your production before March 24, then you should definitely consider whether you fit under this category and avail this reduced rate of 15%. So that is so far as companies are concerned. Of course, above this, 4% education cess is levied, and if your income crosses 1 crore for companies, then you pay 7% of the surcharge on tax, and if it is above 10 crores, you pay 12% surcharge on the tax. For individuals, the percentage of surcharge is a little skewed. Because if you are earning income above 5 crores, then you are paying 37% of surcharge. So that's a lot. So basically, if you are earning more than 5 crores, you effectively end up paying almost 42% of the tax on your income if you are an individual. So that is so far as individuals and companies are concerned. Firms, of course, there is a flat rate of tax at 30%. So if you want to, I understand that the rates keep changing every year, and it is difficult to keep track of that for a layman. You can refer to the income tax website now. So you can just log on to incometax.gov.in, and there are tabs given. So if you're individual taxpayer, company and non-company taxpayers, there are separate tabs. You can just go to that, and you can get an overview of whatever compliance dates are applicable to that specific type. What are the tax rate applicable for the specific case, and you can have a overall picture each year. So you can just when the year starts 1st April, you can just log on to the website and have a picture of which due dates to follow, when to remind your professional as to sometimes that happens. So, and what rates are applicable to you. Again, it is not an alternative to the professional advice. So there may be some nuances, on the website it is mentioned that you pay tax on your income at so and so percent. But what constitutes that income has, it is possible that it has been a subject matter of controversies in the past. There may be some judicial precedents on that. So all that requires your attention. So don't just rely on what is mentioned on the income tax website or Google University for that matter. But of course, it is always beneficial to know at least a basic things. So you can find the compliance dates, rates, and which forms are applicable to you on the income tax website itself. Now, having discussed all these concepts, the next question comes, what is the concept of residence under the Income Tax Act? So, you can be a resident of India, you can be a non-resident of India. If you're an individual, you can be a person who is who is resident but not ordinarily resident in India. So, what are these concepts? Uh, let's speak about individuals first. So, the rule of residency for individuals is dependent on how many days you are spending in India. The general rule is 182 days. If you have spent more than 182 days, then you become a resident in India. Otherwise, you become a non resident in India. So, once you become a non resident, a resident, what you also need to test is whether you are resident but ordinarily resident or not ordinarily resident. So there are complex rules for that. I will not go into much detail. But the basic criteria for determining this is if you are non-resident for 2 out of 10 previous years, or you have been in India for less than 730 days in last 7 years, then you become resident but not ordinarily resident. What is the difference? Global income of a resident is taxable in India, whereas for a non resident, only Indian income of that person will be taxable in India. In case of person who is not ordinarily resident in India, only that income which has which is firstly under a business or profession which has some link to India will be taxable in India. So what income will be taxed in India depends on your residential status. Now let's go to the company. So how do you determine whether a company is resident or non-resident? So all the Indian companies, that means the companies which are incorporated in India under the Companies Act, will be by default treated as residents. What happens to the other companies, which are foreign companies? So in that case, if the place of effective management is in India, this is a concept which is specifically defined under the act, and there are like huge rules relating to that, because this particular uh, phenomena has been used, to create tax structures to reduce your tax liability in India or generally globally. So there has been initiative by all the countries internationally to monitor these kind of structures, and accordingly amendments have been made in the domestic laws of various countries. So this has been a part of that initiative. The poem rules, as we call it, place of effective management, are a certain set of rules to determine where exactly the control of that entity lies. So there have been criteria prescribed. For example, what is the asset based? Uh, so if your total asset base forms of say 100, and out of 60 are based in India, or maybe the employees, out of total number of employees, more than 50% are in India, then your board meetings, or a place where your board of directors reside, all these factors matter in determining where the actual control lies in India. Earlier this provision was different. Unless your entire control was in India, you were treated as a non-resident. But that was misused in the past by some taxpayers. So that's why this concept has been brought in. So now, if you are not incorporated in India, even then you need to be very careful as to see whether you are becoming a resident of India by virtue of these provisions. Then next comes firms, LLPs, and AOPs. So in that case, even if a partial management and control lies in India, they will be treated as residents of India. So suppose there is a firm which is run by me and Nayan. Nayan is sitting outside India. I'm in India, but we, for all practical purposes, or paperwork, we say that Nayan is the managing partner. She runs the business. But even if there are some decisions that I take sitting in India, then the control and management is at least partially in India. So that firm will be treated as resident of India. So, as I said, why this categorization is important is not just in case of individuals, but for all taxpayers. For a resident, the global income becomes taxable in India. Okay, so if I'm a resident, I have certain salary income here. I have some investment income from USA. I have some property in the UK, and I'm deriving some income from that. That entire global income will be taxable in my hands in India, just because I'm a resident of India. However, in case of non-resident, only the income which accrues or arises in India will be taxable in India. Other foreign income will not be taxed here. So that is the basic distinction. Now, what is meant by accrued or arised or received in India has got a lot of connotations. There has been, various appeals on this issue. There have been many judicial decisions on this. So, this is something that has been a subject matter of extensive scrutiny and litigation. So, you need to be a little careful as to, even if you have some connection with India while earning that income, you should be very careful to see whether it is deemed to accrue or arise in India or not, and whether you are, having any tax liability in India or not. So what
Jenny,
happens?
just one small question. For our
Yeah.
audience, can you please explain the deemed to accrue in India, the concept of income? The
Uh,
deemed to accrue, the actual received
okay.
or accrued.
Okay. So for example, uh, suppose I'm a non-resident, not sitting out of India, but some resident is paying me some professional fees for technical services. Okay, that I have rendered to the resident of India. Now that income by default is defined to be arising out of India. Even though I'm the recipient, that income belongs to me, I'm not resident of India, I'm not present in India, the income is not received in India, it is received say in USA. But under the act it has been defined that this type of payment will be deemed to accrue or arise in India. So FTS, fees for technical services, is such example. So we can say that it's a deemed income. So, irrespective
Right.
of the
Right.
place of residence of the recipient, it will be treated as income in India, and it will be taxable in India. So, that
Yeah, so
is,
it concludes that the actual receipt in India is not required in Sudan.
yes, when there is a specific provision to that extent, to that effect.
Yeah, sure. We can move ahead.
Yeah. Uh, so, as a result of all these provisions, sometimes what happens that by virtue of my residence, I get on get taxed on my entire income here, but the country in which the income has actually arisen, for example, in as I said, I have a property in the UK and I'm earning some income from that property. Now, UK will also say that, okay, but even though the person is in India, the property which earns the income is in the UK. So that's a source country. So why should UK not have a right of taxation? So they will also impose tax on that income under their domestic laws. So now what happens is there could be double taxation of the same income. So to avoid this kind of scenario, the countries enter into some agreements which are called double tax avoidance agreements, or DTAA in brief. So these agreements provide for specific reliefs as to which country will have right of taxation of what income. So they have given the categories of income and they have specified that which country should tax that income. In some cases, to certain extent, both the countries will have a right of taxation. They will provide that, okay, up to 10% both the countries can tax this income. But in that case, generally there are also rules which provide credit for such tax paid. So if I'm paying tax on certain portion in both the countries, generally my country of residence will give me a relief to say that, okay, so your tax liability is this, but you have already paid X amount of tax on the same income abroad. So I will reduce that from your Indian tax liability and you pay the net in India. So that is just a very broad framework that I told you. Like all other tax matters, there has been a lot of litigation in this area as well. So you need to be very very careful while opting for any benefit under the DTAAs. So now we have seen how the tax is computed on the income of a person for a year. Now how that tax is collected by the government. So there are three modes or mechanisms provided for this. One is tax deducted at source, or TDS as we know it. So TDS is basically something that the payer needs to deduct at threshold before the income reaches the payee. The payer will deduct a certain part of tax on that income. The next category is advance tax. So if I'm carrying on a business or profession, then I'm required to pay certain percentage of my total tax liability, which I estimate at the beginning of the year, and pay a certain percentage at quarterly intervals. What is the reason for that? It's very obvious that government also needs money to run the country, and if everybody starts paying tax at the end of the year, then that may cause cash flow problems to the government. So that is why the provision of paying quarterly advance tax. And the third category is self-assessment tax. So if I find that whatever TDS has been deducted or whatever advance tax has been paid by me is short of my actual tax liability at the end of the year, which I compute based on my actual income. Advance tax is obviously paid on estimate of income. If I find at the end of the year that there is a shortfall, the balance is paid by me as self-assessment tax. Now, coming to the TDS, because a lot of people, have uh, difficulty understanding the concept of TDS. So, uh, simple thing, if I'm receiving professional fees from Nayan will deduct 10% of those fees from my income at the threshold. She will have a registration number called TAN. So she will file a return under her TAN and deposit that tax which she has collected on my behalf to the government. Now, while filing that return, she will mention my permanent account number, my PAN. So that 10% tax that she has deducted will keep reflecting under my name as the tax that has been deducted on my account. So whatever my tax liability is on that income, for example, if say the income is 100 and she has deducted 10, at the end, assume that there are no expenses and 30 is payable as tax. So the 10 that then has deducted will be reduced from my tax liability of 30 and I will pay 20 as my advance tax or self-assessment tax.
Yeah.
So in your 26 AS, I think most of you will be aware because that's a very common document. So in the 26 AS, what reflects under your name is the tax which has been deducted by your payer on your behalf. Now, it may so happen that what is reflected under 26 As does not belong entirely to the income that you are offering in that year. Okay, so there could be two reasons for this. Um the payer's accounting system and my accounting system are maintained either or cash or mercantile, and there is a difference. Or it may so happen that I am offering certain income in year, say, 2, but the payer has accounted for that expense in year 1 itself. So she has deducted my TDS, she has paid. So my in my 26 As, my TDS is being reflected in year 1, but I offer that income in year 2. So you need to be careful as to keep track of that. A lot of people ask me that mine is a very small business and I don't have extensive records and everything. But for the purpose of claiming this TDS, you need to have at least the basic records, right? You need to know what income you're offering in a year, and whether the TDS that is reflected in your 26 years belongs to that income or not. If it does not belong and you're going to offer that income in the subsequent years, then you need to carry that portion forward to the next year. So you cannot claim that TDS in year 1 itself. You need to carry that forward in your ITR, and then set off against your income when you finally offer it to tax. So that is something that that basic record has to be maintained even for a very small business. And otherwise, once you get into a habit of not maintaining that record, eventually your business grows, and after maybe 2 3 years it becomes extremely difficult to keep track of that entire tedious reconciliation. And we see clients on regular basis that after 5 years they have completely lost track of everything, and now their TDS credit is being denied and the entire reconciliation needs to be done. So we need to go back to 3 4 5 years and reconcile everything, which then becomes a very difficult task. So right from year 1 itself, that track has to be established and that proper record has to be maintained. So that was about levy or collection of taxes by the government. Uh, so just briefly, uh, to give you an idea what happens after you file your income tax return. Okay, so you render on 31st July or September or whatever due date is applicable to you. You filed your income tax return. Now, what happens to that return later? Okay, so that return gets processed by CPC, which is a centralized processing center, which is based in Bangalore. So CPC means that the return gets processed automatically. They have certain conditions that if this is case A, then this should be the outcome. This. So no manual processing is involved. No assessing officer does not see that return. It gets mechanically processed, and you arrive at some refund or tax payable amount. If the CPC code does not match with what you have filed and there is some discrepancy, maybe you have filed some claim, some deduction, but for that there was some condition of filing some form that which you have not fulfilled. So there will be an error in the CPC and they will deny automatically that deduction to you. So in that case where there is a proposed adjustment from CPC side, which has an effect of increasing your income or reducing your losses, they will give you a opportunity to correct or explain as to why that adjustment should or should not be made. So you will receive an email from CPC side to say that this is the proposed adjustment and what is your reply to it. So if it is a genuine case and the deduction is actually due and there has been some mistake from CPC side, you can just explain that. And if it is accepted by the CPC, then in that case a person is actually involved, so somebody actually reads your reply and decides what to do on that. So accordingly, your reply is considered and that adjustment is either made or not made. Now at this stage, I see that many new business owners are not in the habit of checking their email IDs or the income tax portal which is there. So the notices are issued, they are uploaded on the portal. emails are not noticed or just ignored, and so you miss that opportunity of giving a reply to the proposed adjustment, and that then adjustment is made, and then you get an intimation from CPC that while you had claimed that your return is 100, your return income is 100, CPC has determined your income to be 1000 because of these adjustments. Now what I can do is I can file for a rectification. If not, I can file an appeal to the appellate authority. I was just earlier, other day, I was in income tax appellate tribunal, and some other matter was just going on before mine came up. So this was the same issue. Under the intimation received from CPC, there was some adjustment made, and which was clearly against the law. But the assessee had not filed a response to the show cause notice that was sent by the CPC. So the members, or the judges, as you may call, were asking the assessee that why. So you must have received an email from the CPC asking whether this adjustment should be made, or what is the explanation for not making it. Have you replied to it? So assessee said that no, I did not monitor the email. I did not monitor the portal. So they, or the portal, the notice was not there in the portal at all. So the next question that they asked, if it was not there on the portal but you had received a email which is, you cannot respond to that email, the action has to be taken on the portal. If your difficulty was that portal was not working or it was not there on the portal at all, did you take any action? Did you inform the CPC or assessing officer by writing a separate mail that I have received this, but there is no facility to correct this on portal? Or did you at least take screenshots? So, as the things are moving toward faceless or everything is becoming automated, these things keep happening. But if you're facing some issue, you need to create a documentary trail for it. If the portal was not working on the given due date, and therefore you could not file certain return, or you could not take the action that you were required to, take a screenshot of that, create that documentation, you file a letter with the assessing officer on the same day stating the fact. Then it helps you avoid subsequent penalties. Okay, because you have a reasonable cause for not complying with the law. But this is something that a lot of new business owners miss to do, and therefore the cost of compliance ultimately ends up to be very high. So this is the factor that needs to be considered. Okay, so now we reach to the intimation stage that your return is processed, and your determined income is intimated to you by CPC. Now, in some cases, your return will be picked up for a scrutiny. So, in that case, you will receive a notice under section 143(2) stating that your return has been picked up for scrutiny, and you provide all the supporting documents which you want to rely upon in support of your return of income. Then there may be certain further annexures or specific details which may be required that you furnish them, and ultimately the assessing officer passes an order which is regular assessment order under section 143(3). He may make some additions to your income, or he may accept your income as it is. If you are not happy with the order, if you believe that some additions which were not warranted have been made, you have an option of filing an appeal before Commissioner of Income Tax Appeals. And after that, the next appellate authority is Income Tax Appellate Tribunal, that is ITAT. So that is how the entire process of assessment works. So yeah, so I think I've given a broad picture of the basic income tax provisions that are applicable and how the assessment procedure of your income works.
Yeah, absolutely, Shelby. So now we are familiar with the basic concepts, and while understanding with the basic concepts, we got to know what is income in the first place, who is liable to pay tax, even at what point the person is liable to pay tax, as well as we got to know the different tax structure applicable for individual partnerships, LLPs, and body corporates like companies. And Shelby, you discussed the concept so well, and the way of explaining really helped to understand the technicalities of the income tax law in a very lucid manner. So moving ahead with the next subtopic, explaining the concept of assessee, you mentioned firm and LLP as different constitution from income tax angle. So
Yes.
by this, we definitely understand that tax structure is going to be different for all of the structure. So let's take a scenario. If a person is having LLP and the person wants to get it converted into private limited company, what would be the tax implication in that case?
Okay. So when you are currently incorporated as LLP and you want to convert into private limited company, uh, from the procedural aspects, there are steps, of course, which is not a subject matter of today's discussion, but you will have to apply for a name of the company, which will be which could be a different name from the existing LLP. Then you have to get your memorandum and articles of association drafted, and then you need to file one form for the conversion to the MCA. So that is the procedural aspect. But I think what is expected here is what are the tax implications arising out of such conversion. So the concern could be that when you transfer your asset to a new entity, now as I mentioned, LLP has a separate legal identity, and a private limited company also, in the eyes of law, it's a different person other than the LLP. So when you transfer your assets from one person to another, that triggers transfer under the Income Tax Act, which then gives rise to the capital gains tax. However, in this specific case, even under the Companies Act, earlier it used to be called as Part 9 conversion. Under the Income Tax Act, there is a specific provision to say that if you transfer all your assets and liabilities to a new entity, that is the private limited company, at its book values, then it will not be treated as transfer, and therefore there will not be any tax implication in that case. So if you are just converting, obviously, very technically speaking, the both of these are two separate persons, but that exemption has been granted under the IT Act to say that okay, we understand that this essentially is the same person. So provided that you comply with these conditions and the transfer is made at book values, then you don't need to pay any tax on that.
Yeah, so technically speaking, there are two possible scenarios. One is charging the income under capital gain, or if a person wishes to transfer all of the assets and liabilities, then that would be considered as a book value transfer, and there will be no tax in that
Yes.
situation.
Yes. And in the
Yeah.
typical case of conversion, obviously all the assets and liabilities will be transferred. So so long as they are not, revalued and they are transferred at book values, you're good to go. There should not be any tax implications.
All right. Uh, Thank you, Chaiti. That's a very extensive and detailed discussion, and you clearly portrayed the differentiation really well. Now we will move towards the next part. Let's say if a business is new and it requires time, then it obviously requires time to arrange funds to align operations and then ultimately earn profits out of it. And
Right.
I believe there are certain exemptions available under the Income Tax Act, which allows businesses to run and go without paying tax for a certain period of time. So how
Right.
is it? Is it applicable to everyone? What are the conditions and what are the technicalities specific to this scenario? The exemptions and deduction part.
Okay. Before going to specifically newly incorporated businesses or startups, just have a look at what factors you should consider for deciding as to what business structure uh, you want to get into. So there could be three or four factors. One is, of course, I mean, what is the object of your incorporation of the business? So what are the incorporation formalities that you are required to do? If I'm an individual and I'm not expecting that, my business will grow to 500 crores, or I'm the only person who is investing in that business, and the income that I'm going to earn out of that business is, say, not exceeding, for the sake of comparison, 5 crores, and my surcharge is not going to, as I mentioned, my ultimate tax rate is not going to be 42%. If those are my objectives, it is maybe better to run my business as a proprietorship, or as a sole proprietor. However, if my object is, to have other investors in my business, or I'm expecting that my turnover will grow multifold, then in that case it may be more beneficial to incorporate a company or LLP, depending on the number of members that would be joining your business. So those are certain factors that you need to consider. Now moving to your question, uh, even I get a lot of questions to say that, okay, mine is a very new business. So do I need to pay taxes in the initial years? So that's a very common misconception that every new business is eligible for a tax holiday or not paying taxes in initial years. As I mentioned at the very beginning, income tax is something that you pay on income earned by you. Okay. So even if you are a new business and you're not making profits, then anyway you're not required to pay tax because you are not earning income. So to say that just because my business is new, I should not be made to pay taxes is something that doesn't fit into logic. The exemption is available only to certain types of businesses which are called eligible startups. So, who can be eligible startups is a company or LLP which has been, registered with the government as a startup, which has that startup certificate with it, and who meets certain other conditions. For example, that such business has to be set up for innovating some new ideas or new processes or developing upon some new processes, either that or that business has a potential of creating a large scale employment or generation of wealth. So you have to fit in either under either of these two conditions. Then your annual turnover should not be more than 100 crores, because when this exemption or this relaxation is being provided to you, it is meant for small businesses. So your turnover should not be more than 100 crores. Your business should not be formed by splitting up of the existing business. So what I mean by splitting those is that there are cases of demergers. So my business is already running. I have some division which I think that, okay, this fits in the criteria of innovation. So I will just demerge that division. I will create that as a separate company, and then I will apply for a registration as startup. So that will not work, because it has been specifically provided that it has to be a new business, and it cannot be established by splitting up of any existing business. So if you meet all these conditions, you can apply for one exemption, for a registration which you require for claiming this exemption. So you will have to apply to the income tax department to get that registration. They will ask you hundreds of things. That process is very, very, very tedious, because obviously the benefit is so huge that income tax department wants to be thoroughly sure that you're a deserving business. So they will ask for a lot of documentation. They will also ask you to give a slide deck of what your prospective plan for the business is. So you need to have at least a plan for next 5 to 10 years, and you should be able to demonstrate it. If you are falling under the innovation head, then you need to have some plan for the research and development that you are going to invest into that business. So after examining all this, if they feel that, okay, you're eligible to be certified as a startup for this purpose, they will issue a certificate. And once you get that certificate, 100% of your profits which are arising from that eligible business will be exempt for 3 years, 3 consecutive years. Now, a question may arise that, okay, this is my year one, I got that certificate, but I'm incurring only losses. I don't have any income. So the provision says that you can claim that benefit for any consecutive 3 years in a period of 10 initial years. So for 7 years first, if you are incurring losses, and in the last 10 years you have sustained some gains, then you can claim that deduction in the last 3 years. That depends on you in as to in which year you want to start claiming that deduction. But for 3 years, your entire 100% profits will be exempt. This is section 80 IAC. So as I mentioned that the standard exemption is not available for every new business. It is only reserved for eligible startups. So having said that, there are certain other benefits that you could get if you're a new company. For example, say I want to set up a new business and I incur some expenditure for that even before my business starts running. I consulted some professional, I paid the professional fees, I paid legal fees to get the groundwork done, or maybe I paid a consultant to get a feasibility report to study the markets, whether I should get into the business or not. Now, that is clearly not an expense which can be relatable to that business, right? Because I have not even started the business. So, what happens to such expenditure? So that expense you can claim once you start your business over a period of 10 years, 1/10 each year. So, so that is the benefit that has been provided to all new businesses. Now, okay, I mentioned 100% deduction for the startups. There are certain other benefits also which are available to startups. Uh, One of them being, let me first mention how the valuation of a startup is relevant, or valuation for any business for that matter is relevant from tax perspective. So there are certain anti-tax avoidance provision which provide that, for instance, if I'm a company and I issue share capital, okay, somebody purchases my shares or subscribes to my shares, and value of my company is X, value of my share is say 100 rupees, and if I sell those shares, or the shares are issued by that company to a person at say 200 rupees, then that difference is deemed as income. So that is a deeming fiction that has been created by the Income Tax Act. So that is why valuation becomes very important in this case. Okay, generally, if it is a new business, new company, and you are growing, you will want more investors to come in. You will want to issue shares to those investors to buy a stake in your company. So at that point of time, because of this reason, the valuation of the company becomes very critical. And generally, in case of a new business, the okay, so valuation methodologies may differ from company to company, and for what purpose that valuation is required. So there are rules of valuation under which certain types or certain methodologies for valuing your business have been prescribed. But generally, what happens in case of a new business is the methodology adopted is DCF method, which is discounted cash flows. So what happens is the valuer will estimate your future cash flows depending on your business plan. Sorry, depending on your business plan, and he will arrive at a value. So assuming that everything goes according to your plan, after a certain number of years, your returns on your capital will be X. So that's a complex formula. Based on that, DCF valuation is derived. Now, for income tax purpose, what the assessing officers used to do is they used to challenge that valuation. Okay, so if I allotted shares at say 200, they will say that no, it is too unrealistic, because right now you are earning income of X per year. You have envisaged a growth of say 5 times of current year for each year. You are expecting that today my income is 1, next year it will be 5, after that it will be 25. In a new business, that can actually be the fact, because the growth potential is very higher for a new company. But assessing officer used to challenge that, and they would say that okay, you have issued a share at 200, but your actual valuation is 100 only, so I will tax that difference of 100. So, for startups, there has been a specific provision to provide that whatever valuation has been derived will not be, so assessments will not be reopened of startups based on the valuation. And whatever valuation according to DCF has been provided will be accepted in case the assessments are already opened. And if new assessment is to be reopened, it will require a permission of certain level of income tax officers, that say a commissioner or principal commissioner. So assessing officer will have to take prior permission of that officer before reopening or starting your scrutiny assessment, just on the basis of valuation of your shares. So those are certain additional concessions or relaxations that have been given to the startups, which helps a lot in reducing the litigation that is caused only on account of valuation of your business. So those are certain you know relaxations or benefits that are available to new businesses and startups specifically.
Yeah, definitely. You clarified it to be really well, and we get to know that exemption is not a exemption or reduction, whatever it may be. It is not available to every new business, but you have to be considered as an eligible startup to have the benefit.
Absolutely.
All right. Now let's have some case specific related questions. Let's dive into export of goods and export of services part. So, is there relaxation on export of services, or is it the tax applicable on it likewise?
Okay, so that is again, this question arises out of confusion between direct and indirect taxes. As I mentioned, the income tax is levied on income of a person. Okay, so the taxability will depend on who is earning that income and where that income is earned. So even if I'm exporting the service, if I'm a resident and I'm running my business in India, just because that service is availed abroad will not exempt me from paying taxes in India. This concept specifically kicks in case of indirect taxes like GST, where export of service, there are certain exemptions or relaxations which have been provided in case of export of services. So you don't have to collect GST uh, in case of export of services, but that is indirect tax. From income tax perspective, as I mentioned, who is earning that income and where that business is set up is more relevant than where that service is availed.
Yeah, we can move ahead.
Yeah.
Continuing to the previous question, let's talk about NRI's taxation. If non-resident Indians are earning income outside India, but they are domiciled in India, then how those cases are treated under income tax law?
Okay, so when you refer to NRI, am assuming that the person is because the domicile is mentioned to be in India. I'm assuming that the person has moved out of India, but for that fiscal year, he still continues to remain a tax resident of India. So, in that case, just to take an example, I have spent, say, more than 182 days, say 200 days in India, and for the rest of the time of that year, I'm residing abroad. So, in that case, I still continue to be a resident of India under the provisions of Income Tax Act, and as I mentioned, my global income will be taxable in India. So if there is a double taxation of the same income by virtue of the source of income being outside India, the country of my residence, which is India in this case, will provide certain relief to the extent of the tax that I have paid abroad in respect of the income which is doubly taxed. So in that case, even though I'm residing abroad, what is relevant here is the tax resident, whether I'm a tax resident of India or not. So maybe in the immediately next year, if I've moved out of India for good, maybe in the next year I become a non-resident, and in that year, then I can claim that okay, now I'm a non-resident of India. So whatever income I have earned abroad will not be taxed there, and it will only be taxed in the country of residence. However, if I'm having still any investments in India, even though I'm a non-resident, the source is still in India. Therefore, India will have a taxation right, even though I'm a non-resident. I hope that clarifies.
Yeah,
Yeah.
I think it clarifies really well. Going further, by discussing the previous topics, you mentioned LLP, that is limited liability partnership, multiple times. So how does it differ from limited liability company, LLC, or how is it treated here?
Okay, so uh, in India, we do not have any concept of LLC. That's a typically concept which is there in the USA. LLC is not an Indian concept. We either have companies which are private limited companies or public limited companies. or one person companies for that matter. Or on the other hand, we have LLPs, which are limited liability partnerships. But for that, you need to have at least two partners. LLC is not a concept which is there in India. If we talk about one person companies, that's a really good blend between, sole proprietary business and a company. So if I want to run my business alone, but I want to enjoy certain benefits of a company such as limited liability or perpetual succession, so what the option that I have is to convert into one person company. But under the Income Tax Act, there is no such different categorization. It will still be considered as a company only, even though it is a one person company. So all the other provisions of, getting filing the return even if there is no income, or the tax rates which are applicable to the companies, will equally apply to the one person companies as well.
All right. Moving ahead, some organizations work on non-profit basis. So NGOs, we call them in layman's language. So what is the form and structure assigned to them by Income Tax Act or say Companies Act for that matter?
Okay. So we are essentially referring to charitable organizations. So there could be different forms in which a charitable institution can operate. One as a cooperative society, as a trust which is registered with Charity Commissioner, Public Charitable Trust, or as a Section 8 company under the Companies Act. So if it is a company, it can be registered under Section 8 of the Companies Act as a charitable company. Now, what it means under the Income Tax Act. So, if you are into charity, you are not running any business per se, or you're not earning any income, or you're not running a business for the purpose of earning income. Incidentally, you still may earn some income out of it, but your object is charitable and is not to run a business. Then, and you are incorporated into these two or three forms that I just mentioned, you can apply to the income tax department to say that, okay, I'm a charitable entity. You grant me one registration which is under section 12A. So you grant me that registration to say that my objects are charitable. So that document entitles you to claim exemption in respect of your income. So once you receive that 12A registration, then every year you have to ensure is, if you are earning income, you spend at least 85% of that income on the charitable objects for which you have been granted approval. For example, I am a trust which is engaged in providing medical relief, and I've been granted a 12A registration. In a particular year, I earn an income of 100. So what I need to ensure is I spend 85 out of that 100 on the object of medical relief. So in that case, nothing remains taxable in my hand. The remaining 50, even though it is laying with me, there's no requirement that I have to spend it. There will not be any tax in my hand. However, if I'm not able to utilize that 85 in that year, say I'm only able to utilize only 60, so I can accumulate that remaining 25, which can be utilized in next 5 years. So in the year one, there is a shortfall in spending that 85 of 20 or 25. I accumulate that. I have to inform the assessing officer that, okay, I was required to spend 85, but I have spent only 60. Remaining 25, I'm accumulating to be spent in the next 5 years on so and so objects. So I have to give specific objects, that on these objects I will utilize this amount. So for 5 years you can still accumulate that amount and spend on your objects. At the end of 5, if you are still not able to utilize that on the charitable objects, then in the fifth year it gets taxable in your hand. So that is the broad framework of taxation that is applicable to charitable trust. But there are some conditions. Actually, to say use some conditions is also an understatement or a little misleading. So there are a lot of conditions that a charitable entity, including Section 8 company, needs to fulfill. The rules and regulations governing the charitable institutions are very complex. There are number of forms and audit reports and everything that you have to file. And the approach of the income tax department towards charitable institutions is, what can we say, not so charitable. So because in the past, to some extent, these provisions have been misutilized. But of course, I understand that there are, or rather, there are many genuine trusts who are eligible to claim this deduction. But how they are looked at by the income tax department is not very kind. So even if you are a charitable trust or a Section 8 company, you need to be very, very specific in maintaining your documentation, and making sure that all the compliances are taken care of properly.
So as you rightly said, the sole purpose of charitable institution is not to earn profits, but they work for welfare of society at large. But
Yes.
having said that, at the same time, the deductions and the exemptions that are allowable to those kind of charitable institutions depends on the lot and lot of conditions. All right. So moving ahead, Charity, we were in the process of collecting the questions on this team when we decided to host this webinar. So one of the questions that has come up from the audience is that how tax optimization can be done for people who are working as a consultant, but having an annual income greater than once a year, annual income. So
Okay.
how tax optimization can be done for that?
So that's a very, very fact specific question. So when you say more than 1 crore, how much, so if you're above 1 crore, as I mentioned, the surcharge applicable will be 10%. But if you're
Right.
above 5 crores, it gets 37%. So your effective tax rate goes up to 42%. So what is the level of income that you are earning? Then what is your objective? So if you are earning more than 5 crores of income annually, uh, do you want to actually have that income at your disposal readily, or you want to create wealth? Is something that will be a determining factor. So if I want to create a company, one of the drawbacks of creating a company is that okay, I may be able to avail a reduced tax rate of maybe 22% as against my individual tax rate of 42%. But when I take out the profits from the company, I again have to pay tax on the dividends, right? So one of the ways that I can take the profits out of the company is by paying dividend from the company to the shareholder. So if I receive dividend, that income firstly is taxed in hands of the company. Again, when I receive dividend, that dividend is taxable in my hands. So there is a double taxation to that extent. So whether the benefit of rate reduction that I took by forming a company, whether that is serving a purpose in terms of actual numbers, whether I even want to take out the profits from that company, is also something that you need to consider. Or my objective is to create a wealth in that company itself. So profits will still be accumulating in the company. I buy property, so wealth is accumulated under that company. I don't take anything out, so I don't pay tax on the dividend in my hands. The value of the shares of that company that I'm holding, that value keeps on growing. So, is that something that you're okay with, or you want the money in your hands? So, there are a lot of factors or factual parameters that play a role in this. So, it's very difficult to answer, what would be the tax optimization structure. It will depend on a lot of facts.
Yeah, totally understood. So, this clearly sees that what works for one person or one entity might not work for the another
Absolutely.
because it
Yeah.
depends on a lot of factors, also your personal aspirations and what are your business goals, what are your personal goals at the same time.
Yes. Yes.
Yeah. So moving ahead, there is a notion in the society that tax can be avoided in multiple ways, or let me correct myself, that tax can be saved in multiple ways.
Right.
So please throw some light on that. What is legal? What is illegal in this subject matter?
Okay, so what we commonly refer to this aspect is tax avoidance versus tax planning. Okay, so tax avoidance is something which is clearly against the law. You are entitled to certain deduction only if you fulfill certain conditions. You have not fulfilled them, you are aware of that, you are still claiming that deduction in the hope that nobody will notice. That is a clear case of tax avoidance. or you have earned some income, and you just believe that this will not be noticed by anyone because it's a small amount, maybe, or it's not in my bank account, so nobody will notice that. You don't offer that to tax. That is a case of clear cut tax avoidance. But there could be certain cases which are on a borderline. So the line is very thin between tax planning and tax avoidance. Sometimes you take benefits of multiple treaties, or the DTAAs that I referred to earlier, which are the agreements between different countries, to obtain the optimized tax rate. So you structure your transaction is in such a way that uh, in the eyes of law you have not breached any rule. Okay, you have followed the law to the T. But it may so happen that the objective of your entire arrangement or structuring is to obtain tax benefit. There was a case of Google, which was in media for this reason earlier. That was a case where Google paid very minimal tax because it managed to stay non-resident of many countries, even though it has presence all over the world. It structured its affairs in such a way that it paid minimal tax. Or uh, or maybe a case where even under domestic tax laws, you make use of the income tax provisions in such a way that the entire objective is to avail a tax benefit. Otherwise that transaction or that arrangement was not required at all. So that's the gray area where you can't really say whether it's tax avoidance or tax planning. So my advice to everybody is stay out of that. The times have gone where you can hope that nobody will notice this transaction. Okay. The government has so many information sources now that it is hardly difficult that you enter into some transaction and it is not known to the government, right? So the government collects information from so many sources. There have been reporting requirements all over the place. So everybody is required to report so many things that if you are involved in that transaction, that person will have reported your pan somewhere, or somehow. So the times have gone that you can just hope that this will not be noticed by anyone. So do not rely on that. And so far as tax planning is concerned, considering the overall cost of litigation, that and the mental distress that you will go through, it is always advisable to stay in the clear. Because uh, over the past few years the government has also realized that these provisions are being utilized in a way that it is not illegal, but the entire object is to obtain a tax benefit. So there have been specific provisions. GAR, or General Anti-Avoidance Rules, have been brought up in the Income Tax Act to deal with such situations. They provide certain criteria to say that if the sole object of some transaction or a series of transaction, which may be called an arrangement, is a sole purpose of obtaining a tax benefit, and the tax effect of that is more than 3 crores, the assessing officer has a power to overlook the actual legal structure of that transaction and see what actually is happening. So substance over form kind of thing. So the assessing authorities have now been granted the power to say that, okay, even though legally everything fits, I'm going to look beyond your legal form and see what your actual purpose is. uh, Even otherwise, keeping the GAR part aside, even there are other provisions. For example, 56 to 10. If I receive some property without proper consideration, there is a benefit in my hands, right? So it is assumed that I have, or the presumption is that I may have received that difference through some other modes which are not disclosed. So that difference in what I have received and what consideration I have paid becomes my deemed income under section 56 to 10. So all these provisions have been brought in to to find these loopholes that are being used by the taxpayer to reduce their tax liabilities. So going forward, it is very difficult to do something or enter into some transactions which are solely directed towards obtaining some tax benefit. And the overall cost of litigation, if suppose this transaction is not sustained tomorrow, then you are going to pay tax on that, you are going to pay penalties on that, you are going to pay professional fees for litigating that matter. So in some cases, it is possible that even prosecution is initiated for tax avoidance. Not many people know that under Income Tax Act also there are provisions of prosecution where you have avoided tax blatantly. So considering that, it is always advisable that you stay in the clear and not resort to any such modes.
All right. So here we get to know that tax avoidance is a big no, and tax planning is the right way to save tax. If you want to save tax in any manner, it has to be as per provisions of the Income Tax Act.
Yes.
And having said that, if a case gets picked up gets picked up by an officer for a scrutiny, then your intention behind doing anything is really important.
Yes.
And the
Yes.
case is just basis that.
Right.
All
Having
right. So
said
here,
that,
yeah,
sorry to interrupt you. Having said that,
no problem.
only intention is not something that you can rely on. You have to have proper documentation trail for that. Even if you're genuinely your intention was not to avoid tax, but there was some commercial motive, you need to make sure that that properly comes out through documentary evidence. So because intention is a very tricky thing. How will you establish intention? So there has to be a documentary evidence to support your contention, and that has to be taken care while entering into any major restructurings.
I surely agree with you, Cherry. Documentation really plays a pivotal role to prove any kind of intention. All right, we have covered many important topics, maybe constitution of organization, tax benefit, implication of exports, taxation of LLPs, NGOs, one-person company. Now, many important topics and subjects have been covered. So, we are going to discuss tax implication on entrepreneurs to be specific, which is a prominent part of today's session. So, can you please discuss more about filing of tax return, applicability of tax audit, requirement to do tax audit, or maintenance of books of accounts to be precise?
Yes, certainly. Uh, so for small businesses, there has been a provision on the statute book for a number of years now to say that okay, you are a small business, you are either an individual or an HUF or a partnership firm, not an LLP, partnership firms, and you're running a small business. You don't want to deal with the hassle of maintaining extensive records and keep maintaining the books of accounts and everything. So there is a scheme of presumptive taxation. If you are into business and your turnover is below 1 crore, or if you are into a profession and your turnover is below 50 lakhs, uh, you can opt for a presumptive taxation to say that which basically allows you to pay tax on certain percentage of your gross receipts, okay, which is 8% for the business, 6% if your cash transactions are below 5% of your total receipts and payments, then that percentage gets reduced to 6%. So if your turnover is 100, you just pay 8% or 6%, whatever the case is, and be done with it. So that is called presumptive tax. They will presume that 8% is your profit from your business. If you are claiming that your profit is actually lower than 8% or 6%, then you will have to get your accounts audited under the Income Tax Act. So that is the presumptive taxation. But as I mentioned, that is only applicable to individuals, HUFs, and partnership firms. If you are a company and your turnover is above 1 crore, or okay, so there has been a relaxation to say that okay, if you're out of your total payments and total receipts, if cash transactions are less than 5%, then that threshold gets extended to 10 crores instead of 1 crores. So for other businesses, if your turnover is below 1 crore or 10 crores, as the case may be, then you don't need to get your accounts audited under the Income Tax Act. Only if the turnover is above that limit, then a tax audit will be applicable. But of course, depending on your constitution, if you're a company, you are required to get your accounts audited under the Companies Act itself. So this requirement of tax audit under the Income Tax Act is in addition to such specific requirements under the applicable laws, companies laws or LLP Act or whatever. So this is additionally under the Income Tax Act.
Yeah. So in continuation, can you please explain the recent forms that are being introduced by Income Tax Portal? More precisely, Annual Information System, EIS, and DIS. So please throw some light on that as well.
Yes. So earlier, if you remember, there was only Form 26As which was available on the portal, which essentially gave you the details of TDS that has been deducted on your behalf and the taxes that you have paid, advance tax or self-assessment tax in that particular year. So even though that provided you an information about income where your tax was deducted, there are other incomes, on which tax may not have been deducted and that was not reported to you. So for individuals also, it was I mean, they could not be sure that whatever is reported in 26 years is my actual income. There could be certain other income which is not there in 26 years. Now with the introduction of AIS and TIS, uh, fairly, of course, I will not say that 100% of the things will get covered here, but by and large, almost every transaction gets reported under AIS or TIS. AIS is annual information statement, TIS is tax information statement. So TIS, only those transaction will reflect which has a bearing on your tax computation. AIS, there will be other transactions. So for example, if I purchase a property, that will be reflected there. So just to have an overall view that I have purchased a property. So you can refer to your AIS and TIS before your filing of return of income and make sure that everything that is reported there has been correctly included in your income tax return or not. Because if there is a mismatch, then you will get a notice from the CPC to say that okay, this transaction is reported in your TIS, but you have not included in the income tax return. So it is very important to keep track of what is reported in your TIS and reconcile that. uh, there may be certain cases where something is reported under your AIS but the transaction does not actually belong to you. So there is a reporting portal which is connected with the income tax portal. You can just go there and have that information corrected. Or sometimes under that high value transaction campaign, you will get a email or SMS from the income tax department also to say that this has been reported under your AIS. If that transaction does not belong to you, make sure that you point that or you correct that information within time so that you don't face any difficulties after your return has been filed and after you receive a notice from CPC for that mismatch. So it is, even though that is a facility that has been provided by the income tax department to you to make sure that you don't miss out an income, it is also equally important to monitor those statements to see that nothing incorrect is reported there, and if it is so, have it corrected within time.
Yeah, definitely. So as you mentioned that income tax department is already in the process of collecting lots of information from different sources, it is the time that taxpayers should be aware and should be on their toes while filing the income tax returns. And if they feel that the certain information is misreported, then they can definitely go to the portal and file their response to get it corrected or to upload the correct information. So in the continuation, I want to ask further question. What would be the consequences if such information is ignored and if a taxpayer files the returns without considering this information, or in the other case, if a person is liable to file return and the person does not file return at all, what would be the implications in two different cases?
Okay. So the first case is something is reported in your AIS, TIS, and you do not include it. So surely you will get a notice from the CPC to for the difference amount. Now, it is possible that first they send you a notice just to ask for information, which is generally issued under 133(6). So in that case, you just provide that information which has been asked for, explain why you have not included. If it is incorrectly not included, then you offer that to tax by filing a revised return or updated return. But if it is genuinely not includable at all and you have excluded rightly, then you give a basis and you give the documentation in support of your stand. And in that case, it will be dropped. So no further proceeding will be undertaken. However, if your explanation is not accepted, then your scrutiny assessment will be opened. Or if the time for that has already gone, then your reassessment proceedings may be opened by the income tax department. And when that happens, even your other income, which is not a subject matter of dispute, or which is, not the reason for which the notice was issued, all that income also, technically the assessing officer can re-examine and say that, okay, this is right, this is wrong. So you open up to a greater risk by not responding to the information within time. Secondly, coming to non-filing of return. So uh, basically, eh, if you go SSC wise, every company which is a Indian company is required to file a return in India, irrespective of whether it has any income or not in India. A company which is a foreign company will have to file a return if it has Indian income. For the firms, the same criteria applies. If you are resident in India, you have to file a return of income in India. Otherwise, if you have income taxable in India, you will have to file a return. For individuals, for a resident having income taxable in India, obviously the requirement is there to file a return of income. What people miss out is, even if you don't have taxable income in India, there are certain conditions. If you satisfy them, you still have to file a return. For example, if you hold some immovable property above a prescribed threshold limit, area limit, or you are holding a credit card in your own name, which is not an add-on card, or you have taken any foreign trips. So this list is not exhaustive. There could be some other items as well. So if you meet those criteria, then even if you do not have any income taxable in India for that year, you still have to file a return of income. Now, what happens if you don't file the return of income, even if you are required to? So the basic fine for not filing return of income is not that much. It could be 10,000 or something like that. But what will happen is, as I mentioned, your assessment will get reopened, and then you are exposed to a larger risk, of your past income being assessed, or something which is not actually in the nature of income. If you don't respond to the notices, something which is not actually your income will get assessed in your hands. Then you will have to go into the appeal. Then you will have to fight that out. If you don't succeed at the first stage, you will have to go to the tribunal. Then you will have to incur the legal fees for contesting those appeals. So instead of that, the cost of compliance, I believe, is always lesser than the cost of litigation. And interestingly, there are so many people who tell me that, okay, mine is a very new business, it's a small business, I don't have the required staff strength to take care of these aspects, or we don't yet have the money to pay the taxes. So I always tell them that, okay, so when you are starting up with a new business, whatever, I'm into a gifting business, okay, I buy material, I manufacture, or I produce some gift items, and I sell them. I've started that business. I will obviously factor in the cost which is required to purchase the raw material that I require, right? Similarly, the tax cost and the compliance cost are absolutely essential costs of your business, and you have to factor those in when you are starting a new business. There is no alternative to it. Otherwise, if you are not willing to incur the compliance cost, then you are going to end up with a bigger trouble. If you are lucky, for some years you may escape that, but some the time will come when you will have to pay the price for ignoring the cost of compliance. So I always recommend everybody that you treat this as a very essential cost of starting a new business, and you factor that in. And of course, the tax that you pay is on the net profit, right? You are incurring some cost of or professional fees for taking care of your compliances. That cost is deductible. Even after incurring that cost, even then, if you are left with some profit, then only you are required to pay tax, not otherwise. If you're not having profit, there's no question of paying tax. But these costs cannot be ignored, and that's a essential part. I cannot stress this enough.
Surely. I think this is the golden statement of the session that cost of compliance is way lesser than the cost of litigation. And it would definitely avoid further hurdles as well as monetary cost as well as non-monetary cost comes with the litigation part. So it's better to be cautious in the first place.
Totally, yes.
Um, yeah, one thing is while explaining the basic concepts, you have mentioned the TDS, that is tax deducted at source. So can you please extend it further and explain, is it necessary to file the TDS return as well, or who is required to file that, and what are the consequences of non-filing of TDS returns?
Okay. So, TDS basically, so there are certain types of payments on which TDS is required to be deducted. If I'm paying, take an example of professional fees. On professional fees, TDS is deductible under Section 194J. So, if I'm having income from business or profession, then I'm required to deduct TDS, provided I'm not individual or HUF. For individual or HUF, there is a certain relaxation given that if you're running a business and your turnover in the earlier year exceeds certain specific threshold of 1 crore or 50 lakhs, then only individual or HUF is required to deduct TDS under 194G. Uh, but other structures or other assessees, if they are running a business or profession, they will have to deduct tax on professional fees if the specific threshold for that category of payment for professional fees it is 30,000. If that limit is exceeded, then the taxpayer will have to deduct tax. So these conditions for each category of payments are different. So for commission it will be different, for professional fees it will be different, uh, for for salary it is different. So the liability to deduct tax differs from category of payment and category of person. So what happens now, that you have deducted tax, now you have to pay it to the government treasury, right? I have deducted tax, so I cannot just retain that because that money does not belong to me. That belongs to somebody else and has to go to the government. So once you have deducted tax, you have to pay it to the government, and then you have to file quarterly return of tax. So for the first quarter, by first quarter ends in June. In July you will have to file a quarterly TDS statement, in which you will mention the PAN of the person from whom you have deducted the tax. So, for example, I collected 10 rupees from 10 different people. Now I will pay 100 rupees by way of single challan to the government. I will have this the challan serial code available with me. In my TDS return, I will mention that challan serial code, and against that code, there will be 10 deductees, right? From whom I've collected the tax. So against that challan serial number, I will mention 10 different pans of the deductees. So once that statement goes to the government, the PAN mentioned against that challan will enable the TDS credit appearing in the 26 A's of that person. So unless I file my TDS statements, that person will not be able to take credit of TDS that I have deducted. And for non-filing, if I don't pay the TDS which I have deducted, I don't file the TDS returns, I will be incurring a liability to pay the penalty, which is equal to the amount of tax that I have deducted. And of course, the for belated payment, there is also a concept of interest. So there will be 1% interest per month on the amount of tax that I have deducted but not paid.
All right. I think the process flow that you mentioned is really comprehensive. That is, the deductor deducts the tax of a taxpayer. And when the deductor files own TDS return, the same gets reflected in taxpayer's 26 Cs. And that's how the taxpayer can avail the tax credit. So that really concludes the TDS part. I think we have few minutes left, so we can consider the questions from the audience.
Sure, sure.
Uh, the first question from the viewer is, the person falls under the 30% slab. So his or her question is related to ATC. So currently the deduction available under section ATC is still 1,50,000 rupees. So the questions that is being asked is, why the specific limit of 1,50,000 exists in the first place, and if the person having investments more than that, what would be the case of tax implication, or what are the other ways of tax saving in that matter?
Okay. So the intention behind providing deductions or relaxations by way of provisions like ATC is, or was rather, to promote the habit of savings among the citizens, right? So that is why this. So when you invest into something, that money still belongs to you, right? That you are investing out of your income, and that money still belongs to you, and you are going to get some returns on that investment as well. So technically speaking, there was no need to give any deduction of any sort. Or if you are buying some insurance, life insurance, and you are paying premiums, that is that is nothing but application of your income, right? It is not necessary expense for the purpose of earning income. It is for your comfort. It is application of what you have already earned. So technically speaking, there was no need to give any deduction in form of ATC at all. The deduction was granted with the objective of providing an incentive for the individuals to start saving, to start investing in certain securities, or start buying life insurance. So that is a beneficial provision that has been granted. So obviously, having said that, there has to be certain cap on that. So that's why the cap of 1,50,000. I understand the question, because for so many years now the ceiling limit has been same. It is 150 since the time I remember. So I understand the question, but the object behind this was that, and now I think this is my personal belief, that now it is felt that that incentive is no more relevant. That is why this new scheme of taxation or new tax regime, where they have done away with such deductions. They believe that if I give a lower rate of taxation, people are wise enough to invest in whatever modes they want. They don't have to, rely on incentive from my side to invest or something like that. So they have done away with those deductions and reduced the tax rates instead.
Yeah, I think it clarifies the intention of the statute. In continuation, the further question that the viewer has asked, if if the person has other investments, then what would be the tax implications? I mean, other than 1,50,000, or is there any specific deduction available to other kinds of investments?
No, so unless that investment has been specifically prescribed under ATC, that you will get a deduction in respect of that. For example, equity linked saving schemes. So if you invest in those kinds of portfolios, then you get a deduction. But unless it is specifically mentioned, the other investments are not eligible for any kind of deduction. So there may be certain investment plans which say that the income is not taxable now. For example, annuities. So it will differ from plan to plan. So you have to read the terms and conditions of that investment carefully. So it may so happen that the income accruing on that investment is not taxable now, because I'm going to get annuity after say 30 years. So, but other than that, for investing per se, there is no such deduction other than the specifically mentioned investments which are there under ATC.
All right. I think this clarifies the intention of the statute. The next question is, what should be the criteria to convert individual business income to sole proprietorship or partnership in terms of net income earned from that business? I think we should build up like a scenario. If a person carrying on his or her thing personally, and now the person wants to get it converted as a proper business, may it be sole proprietorship or partnership form, then what would be the tax implication?
Right. So, as I mentioned at the beginning, sole proprietorship itself is not recognized as a person under the Income Tax Act. Okay. If I am carrying on the business under my own name, without constituting that business into some other legal form, then I'm just a proprietor, and whatever income I gain from that business is taxable under my own individual name, under my own PAN. I may have a brand name, right? So if I'm running a clothing brand, I may have certain brand name for my clothing business, but unless I actually incorporate that business into some other legal form like company or LLP, till that time it is just a proprietorship, and whatever income I'm earning out of that is my personal individual income only. So even though there is a brand name, it doesn't necessarily mean any that business is a separate legal entity. However, as you mentioned partnership, if I'm having some other person who is also investing in my business and having a stake in my business, then I can of course form a partnership. There could be two types of partnership, which is a regular partnership and limited liability partnership. I already explained the difference between the two at the beginning. So once I incorporate that entity, that becomes a separate legal person for income tax purpose. LLP is otherwise also a separate legal person, but not the partnership firm. So for income tax, partnership will be treated as a separate person than you yourself, and the income will be taxable in hands of that partnership. But otherwise, in the eyes of law, if there is some liquidation tomorrow, then in the eyes of law, that partnership is not treated as a separate legal person.
All right. So audience, if you have further questions, you can connect Shetty on LinkedIn. You can connect with her. You can write to her. Even I would be happy to help to find your answers to your queries. So on this wonderful note, thank you for spending your afternoon with us. Thank you, Chetty, for the insightful session. Your technical expertise really helped to deep dive into the topics. I hope audience would have also gained so much of knowledge and insights from this webinar, and hope to connect with you guys again in future. On this conclusive note, I would also like to thank Neha Mittal from ICAI and Arshita Anand from WEP, who helped us to put this all together from a web's perspective as well. Thank you so much. Over to you, Chetty.
Thanks a lot, Nayan. I am very glad to be a part of such session, and I would also like to thank Niti Aayog and ICI for letting me be a part of this. And I genuinely took pleasure in addressing a lot of basic questions that a lot of people have, because tax laws bring up a lot of anxiety on account of lack of knowledge. And if I could contribute something to reduce that, I'm happy to help. And as Nayan mentioned, if there are any further questions or queries, you can definitely connect with me on LinkedIn.
Thank you so much, everyone. We can conclude this session. Thanks once again and have a great evening ahead. Signing off.